Okay, so this is the chapter on earnings per share. So we're just recording earnings per share to make sure you have access to it. Let's just maximize this. So earnings per share, chapter 14. Now, I mean, it starts off by telling us this is probably one of the most important performance measures used by analysts and used by um, investors to understand how well or to make decisions as to whether or not to where to put their money, if you like, in certain stock. So really, we're literally saying, tell us, listen, what have you earned, if you like, almost what is the yield on a share, if you like, what's the maximum yield. So the maximum yield, of course, is if the company decides to distribute all its earnings. So you have all the earnings, and typically, of course, this is really profit after tax because you pay your taxes first before you were able to distribute anything to shareholders. And so it's really this initial benchmark earnings per share. And so it allows us to, of course, as you can imagine, if I know what the EPS is for Tesco's and I can compare that with that for Asda or whatever in the same industry, at least I can sort of see who's making more money, if you like. If you were to share up all the earnings, of course, as all the shareholders, how much we would get for each share that we had in this business. And then, of course, we can then, of course, compare year on year sort of trends and performance by comparing one year to the next and looking at different accounting periods. Right. So really, this is pretty straightforward. It used to be straightforward, but we continue as we start evolving. And literally, what are we doing? Like I said here, we are literally comparing earnings with the number of shares. But of course, the issue of shares, we want to be, if you like, fair. We want a situation of truth and fairness. So there is a question as to how we deal with these shares, because as you can imagine, you have a business here between January and December. You would have share issues possibly happening at different times in the year, but you have profit being generated over the whole year. The profit figure we see is typically, we almost assume it's accrued evenly, which typically means that any share issue that's happening here has not contributed, if you like, equally to the share issue here or the share issue here in terms of the generation of this profit. So it's important to get a sort of balanced view of what the shares actually are, leading to the generation of profit. And so the standard itself, IAS 33, guides us as to how we define earnings, if you like, what should be considered to be earnings, how do we determine the number of shares to be included, and if you like, the disclosures, the presentation and the disclosures of this. So typically, of course, we're dealing with ordinary shares that are publicly traded. And so publicly traded entities, which present both, parent and consolidated financial statements, if you like, are required to present EPS based on consolidated figures. So listed companies would be very much required to calculate the EPS. And so again, the basic EPS is earnings divided by shares, total number of shares, if you like, to one decimal place. And so I was talking earlier on of this definition of earnings. So the definition of earnings, we're really talking about the group profit after tax. Of course, there's a couple of things we must, because we're talking about what is available to the shareholders. And so if you're talking about a group company, you have to make sure you deduct whatever the profits are associated with the controlling interests. So if you go back to groups, remember that you would look at the subsidiary, and for example, if the subsidiary here, and I'm just assuming here you have 100 million for the year, this is their profit and loss account for the subsidiary. And then, of course, the non-controlling interest, imagine they had 20% of that. So they have 20% of that. So their profits are really 20 million. But when you prepare your group profits, imagine you had 500 million here. What you do is just take off that 20 million, right? It's because this is associated with the non-controlling interest. And we get this figure, of course, from the subsidiary P&L. You don't take 20% of this. No, right? This is the parent. This parent might have other subsidiaries, so we just need to focus and hone in on what's going on with that subsidiary. Anyway, the what we then need to do is think about this idea of a weighted average number of shares, if you like, at the end of the year. So we have this example here that we will look at, and let's just simply look at the situation. Here, 2007 is a very nice one. It literally is. These are the number of shares you have at the 31st of December. These shares worked all year to generate these earnings, and therefore the earnings per share for 2007 is 460,000 over 800,000, which is equal to 460,000 divided by 800,000, and that's equal to 0.575. And then what I have here is 550,000 over 1 million. So of course you can see I've rushed there, and this is a normal thing we would do in error, because typically when you're just doing this in a rush, it's important to realize that actually what's happened here is that we have 1 million shares. I accept that, but what happened was that 200,000 of these shares were only issued halfway through the year. So 1 million shares have not generated 550,000 pounds evenly over the period. No, that hasn't happened. So what we need to do is to do a sort of weighted sort of average. So really, when we do a weighted average, think of it like this. We're saying that at the beginning of the year, and I think it's important to use the table and stick to the table. There are other ways you can get creative as to arguing this, but let's just stick to the table. So for the first 6 months of the year, 800,000 shares generated profit. So for the first 6 months of the year, you can say that, well, 1st of Jan to the 30th of June, you had a weighted average number of shares of 800,000 times, of course, 6 over 12. I mean, if it's for the whole year, I'd just be doing the same thing, right? Again, for the next 6 over, so 12 over 12 times 800 is technically for the whole year. But I'm talking about half the year, so I have 6 over 12, and that's 400,000. And then we bring in some new shares. We issue another set of 200,000 shares. So now we have 1 million shares for the remaining 6 months of the year. So you now have 6 over 12 times 1 million shares, which of course here is 500,000. So what you now have is a total of 900,000 shares. So this is the weighted average, if you like, and that's what we go for. And this has an element of fairness to it. That I mean, you could exaggerate this and say that imagine these 200,000 shares were issued on the 31st of December. They would still be in here, but you and I know that these shares have not generated this, and that's not fair on the managers. Really, in this scenario, this profit was really generated by the 800,000, right, up to the very last day of the year. So it's important to get the weighted average right. So therefore, from a weighted average point of view, my EPS for 2008 would be 550,000 divided by 900,000. So 550,000 divided by 900,000 gives me 0.611. I mean, it says to one decimal place. I mean, it just respond to the answer really. So technically, this would have been 0.6, and but I mean, I still prefer the two decimals, at least 0.58 and 0.61. Yeah, I mean, but again, just work with whatever answers you're given in the text. And that's how we calculate EPS, and that's how we deal with weighted average. We always do weighted average when we have new issues. Really important. Weighted average over the time period. That's important to do that. Okay, I think I've asked you to do TYU1. It's the same as the example. Please do it. There are enough questions in the kit anyway to do, so I wouldn't, if you can't do TYU1, that's fine, but please do it as homework. It's always a good idea to go through the TYUs, and then you're fine. Okay, great. I think I'll stop there, and then in the next video, it's just coming up to 10 minutes, and I'll stop there. In the next video, we'll look at the bonus issue.